A bridge can look perfect, painted, smooth asphalt, no cracks you can see. Then the load changes. More cars, heavier trucks, higher frequency traffic. The bridge doesn't fail because it was built badly. It fails because it was built for a different era. Traditional retirement plans have the same problem. A lot of retirement planning still runs on assumptions from a world with higher bond yields, lower healthcare costs, slower technology disruption, and an economy that rewarded stability. The next decade changes the load, inflation pressure, healthcare shocks, higher market volatility, faster job displacement. From AI and automation, tax complexity from RMDs, and capital gains tax exposure. Your investment portfolio can look fine on paper and still be structurally exposed. This video runs a stress test, not stock picks, a stress test on the design of a traditional retirement plan. 401,000 retirement plan allocations, Roth IRA usage, taxable brokerage account structure, asset allocation strategy, and the behavioral rules that stop panic decisions. One statement in most financial planning templates breaks first bond math. I'll show you the exact failure mode, then we retrofit the bridge. Traditional retirement plans lean on a familiar engine, the 60/40ths portfolio, stocks for growth, bonds for stability. The bond side is supposed to do three jobs: dampen volatility, provide income, and act as a shock absorber when stocks fall. Then, 2022 happened. Bond investors learned a lesson most people never internalized. Bonds can lose money. At the same time, stocks lose money. That is not theory, it is duration risk, meeting inflation risk. This matters for retirement planning after age 55 because sequence of returns risk is real. If withdrawals start while both sides of the portfolio are down, the retirement plan becomes fragile. Bond math is the first point of failure because bond returns are not magic. Expected bond return starts with yield. When yields are low, future expected returns compress. When yields rise fast, bond prices drop. Traditional asset allocation models that assume bonds always stabilize equities get exposed during inflation spikes. That's the structural problem. Now, the second failure mode is quieter, and it hits even when markets are calm. Healthcare. Fidelity publishes a retiree healthcare estimate every year. The number is large enough to change your entire wealth management strategy. Fidelity's 2023 retiree healthcare cost estimate came in around $315,000. That's for a 65-year-old retired couple after tax. It excludes long-term care. This isn't a scare tactic, it's a budget line item that behaves like gravity. Healthcare doesn't care about your portfolio returns. Healthcare doesn't care about your asset allocation pie chart. It shows up anyway. Traditional retirement planning templates underweight this because they focus on market return assumptions. A retirement plan fails faster from expenses than from returns. That $315,000 number connects directly to your emergency fund size, your high-yield savings account buffer, your insurance planning, your withdrawal strategy, and whether your taxable brokerage account is your only liquidity source. This is also where life insurance policy decisions and long-term care insurance discussions enter for some households depending on personal risk. No blanket advice belongs here. The structure belongs here. Now, fold healthcare into the next load. Spike longevity. A 55-year-old isn't planning for a few years of retirement. Social Security actuarial tables show decades. Decades change everything about compound interest, withdrawal rate, and portfolio diversification. A retirement plan designed for 15 years behaves completely differently than one designed for 30. Social Security actuarial life tables make that clear. Longevity is a wealth management multiplier. Longer retirement means more exposure to inflation, more exposure to healthcare costs, more exposure to market cycles, more exposure to tax rule changes, more chances for a bad early sequence of returns. This is why the safe withdrawal rate conversation matters. The 4 rule came from historical U.S. market data and specific time periods. It's a guideline, not a guarantee. When valuations, inflation, and bond yields shift, the guideline shifts a traditional retirement plan fails when it treats a guideline as a law of physics. Now we're 3 layers deep: bond math, healthcare, longevity. The next failure mode is the one nobody sees until it's already done damage. Taxes, not tax season, retirement taxation, RMDs, capital gains tax, Medicare IRMA brackets, Social Security taxation. One wrong account structure turns a decent investment portfolio into a leaky bucket. A lot of people build retirement assets and forget retirement taxes. Tax drag is a design failure, not a market failure. Tax containers matter. A 401,000 retirement plan and a traditional IRA grow tax deferred under current rules. A Roth IRA grows tax-free under current rules. A taxable brokerage account creates capital gains tax exposure, and long-term capital gains are treated differently than short-term capital gains. Then RMDs arrive. RMD rules force taxable distributions from tax-deferred accounts. Forced income changes the tax bracket. It can change Medicare premium brackets. It can change Social Security taxation. This is White Axe planning strategy belongs inside retirement planning, not beside it. Roth IRA conversion strategy exists because retirement income has seasons, working years, bridge years, RMD years. During bridge years, some households have room to shift assets into tax-free buckets. That decision requires careful financial planning, not vibes. Now we arrive at the failure mode that ties all of them together. Behavior. Most portfolios do not fail because math is wrong. They fail because humans behave badly under stress, and the next decade delivers stress, market volatility, plus tech disruption, plus inflation shocks, creates pressure that breaks weak systems. The retrofit has to address behavior. If this stress test feels uncomfortably practical, good. Most retirement content talks about motivation. Retirement planning requires engineering. This channel builds frameworks, investment portfolio strategy, asset allocation rules, tax planning strategy, and behavioral guardrails that keep a plan intact during market volatility. Investment portfolio strategy, asset allocation rules, tax planning strategy, and behavioral guardrails that keep a plan intact during market volatility. The next video breaks down the retirement weak joint that fails first in most portfolios with a step-by-step retrofit. You can apply across a 401,000 Roth IRA and taxable brokerage account. The retrofit starts now. Retrofit starts with the parts that prevent structural failure: liquidity buffer, income planning, rebalance rule. Liquidity buffer is your storage, emergency fund, plus high-yield savings account, plus planned cash reserves for short-term expenses that prevents forced selling from your brokerage account during a drawdown. Income planning includes knowing what produces cash flow in your portfolio: bond interest, dividend investing, dividend stocks, REIT investing income, and in some cases, an annuity decision as part of a broader plan. This is household specific. The structural point holds for everyone. Retirement requires a cash flow plan. Then the rebalancing rule. A written rule prevents emotional decisions. A quarterly or semi-annual review cadence supports risk management. Daily checking destroys discipline. Now, the retrofit that people want to skip: the growth engine. This is where the next tech revolution enters the retirement plan without turning it into a casino. A traditional retirement plan fails when it has no growth engine, inflation doesn't retire, healthcare doesn't retire, longevity doesn't retire. Your retirement plan needs a controlled growth sleeve, a sleeve, not the whole portfolio, a sleeve, sized to your risk tolerance, your withdrawal needs, and your time horizon. AI infrastructure, cybersecurity, semiconductors, robotics and autonomous systems, energy intelligence. These are disruptive innovation themes that rewrite productivity. A tech sleeve belongs in the right container. Roth IRA supports tax-free growth under current rules. Taxable brokerage accounts require capital gains tax awareness. 401,000 fund lineups vary. The point is not the ticker. The point is structural exposure without destabilization. Now, the final retrofit layer, protection, the part that keeps the bridge from failing during storms. Traditional retirement plans fail when the load changes and the design stays the same. Bond math shifted, healthcare costs escalated, longevity stretched the timeline, taxes became steering, behavior became the breaking point. A retirement plan built as a system survives, liquidity buffer, prevents forced selling. Tax architecture preserves spendable income. Sequence shielding keeps withdrawals from destroying principal. A controlled tech sleeve keeps purchasing power alive. Rules keep behavior from sabotaging the design. Subscribe if you want retirement planning frameworks that behave like engineering investment portfolio strategy, asset allocation design, Roth, IRA, and 401,000 container logic. Tax planning strategy and portfolio risk management for the next decade. This content is educational and does not constitute financial advice, tax advice, or legal advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. Consider speaking with a licensed professional for personalized retirement planning, tax planning strategy, and asset allocation guidance.